Welcome, everyone. Thank you for listening to the Council of Institutional Investors Voice of Corporate Governance. I'm Jeff Mahoney, General Counsel of CII. Our topic for this episode of the Voice of Corporate Governance is Critical Audit Matter Disclosures, or CAMs. And my special guest is Keith Czerney, Associate Professor and PricewaterhouseCoopers Faculty Scholar at the Robert J. Trulaske Senior College of Business at the University of Missouri-Columbia. Professor Czerney is the co-author of a recent research paper entitled An Examination of Critical Audit Matter Disclosure Quality. Welcome, Professor Czerney. Thanks for taking the time to speak with us.
Thanks so much for having me. I really appreciate the opportunity to share my co-authored research with you and your audience.
Professor, what are critical audit matter disclosures and why are they so important to investors?
So before answering your question directly, I think some extended background context might be beneficial to listeners who may be less familiar with the auditor reporting model. So for the better part of the 2010s, the PCAOB took an in-depth look at the independent auditors reporting model. This consideration was really motivated by a feeling that the audit had and certainly still has value, but the content of the audit report was not informative. So the PCAOB wanted to identify ways to make audit reports more useful to investors. The biggest change that came out of this standard setting process was a requirement for auditors to disclose critical audit matters, or as you said, CAMs for short, in the audit report. So this disclosure requirement went into effect for the largest companies in 2019 and then pretty much everyone in 2020. So what exactly is a CAM? A CAM highlights an area of financial statements that represent heightened audit risk. To be eligible for disclosure as a CAM, the PCAOB standards say that a topic must satisfy three criteria. One, it was communicated or required to be communicated to the audit committee. Two, it is material to the consolidated financial statements, meaning we think it's a matter or topic that investors care about. And three, it must involve especially challenging, subjective, or complex auditor judgment. That phrase is very specific and intentional, and in fact, our research focuses on this third condition, which we label as sophisticated judgment. So it's probably the aspect of the standard where auditors exercise the greatest discretion. The intent of adding this disclosure was really to enhance the usefulness of the audit report by providing users with greater insight into the more challenging areas of the audit and provide explanation for how the auditor responded to these or such challenges. So for each topic identified as a CAM in the audit report, auditors discuss what led the matter to be identified as a CAM, describe how it was addressed in the audit, and refer to the related financial statement accounts or disclosures where financial statement users can find more information. So topics frequently identified as CAMs include things like revenue recognition, business combinations, goodwill, and allowance for credit losses. Unfortunately, findings from early, primarily academic research, but also practitioner works generally indicate that CAMs lack informational value to investors, where we typically infer value from a little association between annual report filings containing CAM disclosures and stock returns in a short window around the filing. Thus, there's a sense in the community that CAMs may not be important to investors, or at least as important as the PCAOB and constituents involved in the standard setting process had ideally hoped.
Professor, one of the findings of your research is that auditors report fewer critical audit matters than expected on a high percentage of engagements, providing confirmatory evidence that auditors are not disclosing all the CAM topics that might be expected pursuant to the Public Company Accounting Oversight Board's auditing standard for CAM. So why is this happening, and what, if anything, should the PCAOB do to increase the number of CAMs disclosed by auditors?
So this is an interesting question. I think there are several factors at play here. Generally speaking, companies prefer plain vanilla audit reports. They want an unqualified opinion, and in fact, they need one in order to file their financial statements with the SEC. Auditors must additionally identify the financial statements and reporting periods and scope and provide some basis for their opinion in the audit report, but Beyond this, in the pre-CAM environment at least, companies did not want additional disclosures that investors might not understand and even could possibly interpret as red flags. So one example of an additional disclosure in the audit report to which companies may object is explanatory language, which has been the focus of some of my prior research. So as an example, the most well-known type of explanatory language is the expression of substantial doubt about going concern. So although CAM disclosures are now required, companies and auditors may still be approaching them from the standpoint of what is the bare minimum that must be done to demonstrate compliance with the standard so that the audit report still looks pretty plain vanilla, even though it has this additional CAM disclosure in it. And so what does that look like? Well, that means that auditors would probably just identify one item as a CAM each year. After all, one could argue that by disclosing one CAM, this complies with the standard, at least in spirit. And so, oh, by the way, in future years, auditors may be inclined to continue to identify the same item as a CAM, because if the company's business hasn't changed dramatically, why would the item that requires the most sophisticated judgment change? And so I think that's why we've kind of gotten to this low equilibrium level of just disclosing one or maybe two or three CAMs. So going back to the standard setting process, I think there was an acknowledgement from the public accounting profession that something needed to change for it to maintain its relevance. But really, most were not on board with going so far as to require CAM disclosures, or even more extreme, adding something along the lines of an auditor discussion and analysis. So companies and auditors are keenly aware of liability exposure when they are preparing and auditing the financial statements and related disclosures. And so when the PCAOB made CAM disclosures a requirement, there's little interest in going above and beyond, at least that's my sense. From the auditor's perspective, why would they voluntarily provide disclosures of additional CAMs that point investors to the most challenging, subjective, or complex areas of the financial statements that maybe perhaps have the highest ex ante risk of material misstatement? So this information would be immensely beneficial or useful for future litigation should it later be revealed that the company and the auditor missed a material misstatement. Likewise, companies don't want unnecessary disclosures. Again, they want plain vanilla. In terms of what the PCAOB should do to increase the number of CAMs, they're really in a difficult spot, no doubt. I certainly don't envy their position, as there's not a normative benchmark or bright line test or rule that says if you're a company of certain size with X number of significant financial statement accounts, then the auditor should identify Y number of CAMs. This guidance does not exist, and I'm not really sure that it should. To the PCAOB's credit, their approach to standard setting is to generally issue standards written at a very high principles-based level that allows public accounting firms to exercise considerable judgment, ideally in good faith, to try to comply. So the downside of this is that it makes it more difficult to identify and enforce blatant instances of noncompliance, especially with respect to what constitutes challenging, subjective, or complex judgment. So in concluding my response to this question, I guess I'll throw the question back to you and your audience. What would the auditor include in the auditor's report that would make it more informative? In my opinion, I think we know little about who even looks at an audit report and what is truly of interest to them. Additionally, I think interpreting tests that fail to document a significant association between CAM disclosures and equity returns or equity earnings forecasts as evidence that CAMs are not useful, I think is somewhat misguided. CAMs are not intended to be a source of new information about company fundamentals or future earnings, and so CAMs could be serving their intended purpose. We just aren't able to measure it effectively, at least at this point.
Professor, your research used generative artificial intelligence to validate your findings. Can you discuss in plain English how generative AI was used in your research and your views about the relevance of generative AI to accounting research generally?
Yeah, that's another interesting question. So when we first began thinking about this study, there were a few noteworthy challenges that we identified and needed to figure out how to overcome in order to execute the research project. So I'll briefly highlight two of them and then kind of more directly discuss generative AI. So one, we needed to identify a population of topics from which auditors select CAMs. Kind of what is the universe on a given engagement that they're looking at and from which they're determining the 1, 2, or 3, or however many CAMs they're going to disclose. So the way that we address this is that we decided to use XBRL tagged significant accounting policies disclosed in the notes to the financial statements as the population of candidate CAMs. So in our minds, this set of items represented a logical starting point that we think might make sense for auditors to use. The second challenge is that we needed to figure out how much sophisticated judgment each accounting policy required. So we've identified the candidates, but then we needed to measure the amount of judgment or sophisticated judgment in accounting for them, as we would perceive that the ones with higher sophisticated judgment would have a higher likelihood of being selected as a CAM topic consistent with this standard. So there was not an approach from prior research that we could use to do this. So what we did is we compiled a list of words used in accounting policy disclosures that we think reflect sophisticated judgment. So my co-author, Don Zhang, and I developed this list from the corpus of words that were included in our sample of accounting policies, and we considered the context in which the words may be used to infer the extent of sophisticated judgment that they can convey. So we then counted the number of times the sophisticated judgment words from our list appear in each accounting policy, and the count of these words is our measure of sophisticated judgment for each policy. So while presenting this paper at an academic conference last year, we received a few questions about our word list and how we validate it. So how do we know that the words that we came up with truly capture sophisticated judgment? Rather than presenting policies or sentences to humans or human subjects, or think about people on Amazon Mechanical Turk, and asking them to rate the extent of sophisticated judgment, we decided instead to use generative AI. So to do this, we ordered the 200,000 plus accounting policies in our sample by our assessment, again, based on our word list of the extent of sophisticated judgment involved. So next, we randomly selected a sample of 1,000 accounting policies from the top 40th percentile and 1,000 from the bottom 40th percentile. So we have 1,000 high sophisticated judgment policies based on our word list, and then 1,000 low sophisticated judgment policies, again, based on our word list. Then we paired each one of these 1,000 items from the bottom 40th percentile with a sample item from the top 40th percentile to effectively create 1,000 accounting policy pairs. So finally, we fed these policy pairs into a generative AI tool one at a time and simply asked which one of the following two accounting policies requires more challenging, subjective, and complex judgment. So we thought that simplifying the task in this way would be very manageable for generative AI to handle, and that we found ultimately that generative AI correctly identified the more sophisticated judgment policy approximately 94% of the time. So we were pretty happy with this high rate of correct identification. And in fact, when we had the tool complete the task a second time, the performance was nearly identical. And so as a quick point of clarification, going back to your original question, we did not necessarily use generative AI to validate the overarching findings from our study, but we did use it to validate a key measure. That's our independent variable of interest in most of our analyses. So regarding the relevance of generative AI to accounting research, it has certainly impacted the discipline and will impact it, I believe, to a greater extent in the future as generative AI's proficiency and capabilities expand. So the top academic journals have given great consideration to developing policies around the use of generative AI, specifically in accounting research. So now when you go to submit a paper to a journal for peer review, you're required to provide a statement pertaining to generative AI and how it was used in the project. I think, currently generative AI is being used effectively in accounting research to do things like brainstorm new research topics, enhance the clarity and conciseness of writings, maybe just one paragraph at a time, and to write code that can be used to analyze data. So think about different commonly used programming languages. But based on my experience experimenting with generative AI, I find it still to be limited in its ability to provide correct sourcing. So I've seen it blatantly fabricate published studies and then admit to doing so after further prompting. So my hope and preference would be that I strongly advocate for humans to remain at the center of scientific inquiry and peer review, and generative AI remains just kind of another tool at our disposal rather than a replacement for the key role that people and academics play in research.
Professor, final question. You note in your paper that the Investor Advisory Group, or IAG, of the Public Company Accounting Oversight Board, of which I am a member, have raised at least two concerns about the disclosure of critical audit matters. One, that auditors are reporting too few CAMs, and two, the content of CAMs fails to describe what the auditors found during the audit in conflict with the language and intent of the standard. Both of those concerns are discussed in detail in the IAG's December 2024 report entitled The First Annual Investor Advisory Group Most Decision Useful Critical or Key Audit Matters for 2023. That report's available on the PCOB's website. Earlier, we discussed your research findings related to the first IHE concern. So what are your thoughts about the IHE's second concern? What, if anything, should the PCAOB do to improve the content of CAMs so that they are more consistent with the language intent of the standard and investor information needs?
Hearing you ask that question makes me smile because thinking about your first question related to the second concern, in a previous version of our paper, we performed content analysis of auditors' explanations of how they responded to the CAM. However, in response to feedback that we received on previous versions, we were encouraged to try to narrow the scope of at least this project. So we've removed those analyses. But Dawn and I are currently looking to see if we can develop a second paper that really focuses on auditors' responses and drilling down into that text and their disclosures. So I think it's very challenging for auditors to convey their findings in CAM disclosures in a way that's understandable to the average investor. So we must keep in mind that auditors still issue an unqualified opinion on the consolidated financial statements. So despite whatever challenges they may face, auditing matters identified as CAMs, they effectively overcome these challenges to a degree to conclude that the associated accounts are not materially misstated, or they're at least not materially misstated after the client books their proposed adjustments prior to filing the financial statements. So if auditors go into detail about what they found or adjustments they proposed, not all readers are going to understand how these issues are resolved before the financial statements are released. Even sophisticated users we see frequently demonstrate misconceptions about the audit process and what it truly entails. Further, if we want auditors to share their findings in greater detail, could we just require them to publicly disclose their summaries of adjusted and unadjusted audit differences? That's obviously beyond the scope of CAMs, but is that ultimately what we're trying to accomplish if we were asking for more and more disclosure from them about their findings? So I recognize we can't address that right now in this research or even in the standard setting process, but it's just kind of something to keep in the back of our minds. So I do see your point that the standard allows the auditor to provide an indication of the outcome of the audit procedures related to a CAM. However, based on my reading of many CAM disclosures, auditors do not commonly share their findings and may be taking liberties with the fact that they may, as opposed to must, do this, meaning they have discretion over whether or not they share their findings, and failing to share their findings still could be perceived as complying with the standard the way it's written, at least my reading. So looking ahead, I think there are opportunities to enhance the specificity with which they discuss procedures they performed in a way that is understandable to the average investor and really demonstrates better compliance with the current standard. So for example, looking at CAM disclosures, auditors frequently say, "We evaluated the completeness and accuracy of data." And they just kind of leave it as that at a blanket statement. But this really doesn't offer a detailed description of the actual procedures performed. So simply adding what they did to perform this evaluation would be a step in the right direction, using this as a specific example. I also wonder whether the SEC in its review of annual report filings could more carefully consider, even using an automated process, the specificity of CAM disclosures. So if the disclosure is deemed deficient, why not force the company and auditor to file an amended filing? This could serve potentially as a powerful, more timely disciplining mechanism than, say, a PCAOB inspection. So we know that PCAOB has identified in its inspections deficiencies in CAM disclosure, but if we force amended filings, companies are not likely to appreciate having to amend their filing on account of their auditor. So that might be one thing to consider. And lastly, and this is more of a bigger question than it is a suggestion, but even if we got the compliance perfect under the current standard, are CAMs really the information that investors wanted? How is it helpful to know that maybe just one or two or three areas of the financial statements required especially challenging, sophisticated, and complex judgment? How does this information really help users make better forecasts or evaluate management, which are some of the key reasons they look at historical financial information? Investors ultimately want to be better able to connect past performance to the future. And CAMs unfortunately don't do this, and this isn't the direct responsibility of the auditor.
That concludes our podcast episode. On behalf of the Council of Institutional Investors, I want to again thank my special guest, Keith Czerney, Associate Professor, PricewaterhouseCoopers Faculty Scholar at the Robert J. Trulask Senior College of Business at the University of Missouri, Columbia. If you have any questions or comments regarding this podcast, please feel free to contact me at Jeff, that's JEFF, at CII.org. Until next time, I'm Jeff Mahoney. Thanks for listening to the Voice of Corporate Governance.
Thank you for listening to this episode of The Voice of Corporate Governance, brought to you by the Council of Institutional Investors. The Voice of Corporate Governance is a free, non-sponsored podcast that highlights critical developments in corporate governance and other important issues affecting institutional investors. The views expressed by those interviewed on the podcast do not necessarily reflect the views of CII or its members. For more information on CII and its policies on corporate governance, please visit our website at www.cii.org.